you're coming at a very opportune moment. In fact, just yesterday we saw Nifty and Sensex once again, hit all-time historic highs. But much before that, you actually already said that by 2026 end, Sensex will be at 107,000. Now, that's just one case scenario. I just want to understand from you, what are the tailwinds, what are the factors that you've considered while being so bullish on the India story?
Thank you, Pranav, for having me here. It's great to see this campus. Absolutely outstanding. I don't think there's any media house in the world that has this. So wonderful.
Thank you.
Congratulations. So yeah, we have an optimistic outlook. You cited the bull case on the Sensex. There's a base case which also argues that the market is likely going up rather than down. And, yesterday my mother got very excited. She came to me, why is the market up so much? I said, no, it's not up a lot. No, it's made an all-time high. And it's hard to explain this to my mother, but the fact is that in the last 12 months, India has been the worst performing market in the world amongst large markets. So if you take the top 20 markets in the world, India is 20th. And it's been a tough year for India on a relative basis. Markets around India are up between 20 and 70%. So it's a really bad year. In fact, I went and checked the data. This is the worst relative year for India since 1993.
Okay.
So 32 years, we have not had such a bad relative year. There are three reasons for that. And that dovetails into this conversation about what could happen in the next 12 months. So first is India's growth slowed down. Purely for idiosyncratic reasons. Like we were discussing over lunch, India is a quintessential self-help story. So it's probably the only real self-help story in the world, which is investable. And India went through some of its own problems last year. Because of elections, government spending slowed down. We had a very heavy rainfall in August. The RBI was keeping policy tight. And we arrived in the September quarter with much slower GDP growth than what we had anticipated. And the effect of that was felt on earnings in the next 2 or 3 quarters, which then, of course, comes through in share prices. So that was one. Second is that India's relative valuations, and this is less important for us sitting here at home, but a lot more important for investors abroad. And it explains why foreign investors have been selling to some extent. Relative valuations were at all-time highs.
Right.
Now, as a consequence of this steep relative correction, India's relative valuations are now near all-time lows. Okay, so that's the second thing. I forgot to tell you about the first thing is that we've now gone about fixing that. There was a policy pivot that the RBI made in February. In fact, in April, the RBI cut CRR and interest rates. And in the last 25 years, since we moved to the repo rate, that's only happened twice. Once during the global financial crisis and once during COVID.
Right.
And frankly, April did not resemble any crisis.
True.
So it was unprecedented policy response, and it has been then backed by the government on multiple fronts. I'm not going to repeat that. We all know what has happened. So in the last 6-8 months, we've had such multiple policy responses that I tell my people back in the office that if India's growth doesn't turn, we'll all have to retire. It is but obvious that India's growth is about to turn. And the third reason, which I think is still in play, and this is especially over the last 6 months, the world has been obsessed with AI. And anything AI has gone up, and India does not have a direct AI trade. So it has not been a favored market. I think while I cannot call the AI trade, a lot of that has happened now. So incrementally, it will be probably a less important factor. So going back, I've explained why the markets did not do well and why they could do well. Our relative valuations are much better. Our growth cycle is about to turn and turn quite sharply. And I think the AI trade at the margin is less important. So this is a good setting for India. The next 12 to 18 months, I expect the markets to do quite well. In fact, I'm very bullish. I shouldn't say this because I've got a bad reputation now of being perennially bullish, but I just can't help being bullish.
Were you ever bearish on India?
Many times. I've been
When was
bearish.
the last time you were bearish on India?
See, first of all, everybody should understand here that equity markets are not meant for 12-month investors. If you are focused on earning 12-month returns, you're better off doing fixed income. Equities is really for long-term investors, people who are willing to make a 5-7 year commitment. So these 12-month outlooks can go wrong very often. 5-7 years, things start evening out. So if you rely on my 12-month forecast, then the toss of a coin will do a better job. So that is the challenge in equities, that they become very difficult to forecast on near-term basis. Like even today, I can say, so many things can go wrong in the next 12 months. And that could make my forecast look very stupid, like they did in the last 12 months and made my forecast 12 months ago look not so good. So I think, I've been bearish in the past, maybe 2013, 2007. I think those are the two occasions I remember.
So what has changed between 2007, 2013 to now? What exactly has changed over the past 12 years?
Pranav, so much has changed that we will run out of time. But let me try to...
Now that you've postponed your flight, we have all the time.
Let me summarize this in 3 big takeaways. So I think our previous speakers have alluded to this, so there may be some repetition here, so bear with me. But I think the first thing that has changed is macro stability. So in very simple terms, it's how much India depends on the world for its growth. So if you look at, and I was discussing here with a couple of you, that equity returns is not about growth. It's about balance sheet. If you manage balance sheet, so when you're searching for businesses to invest, you must look at businesses that manage balance sheet well. And I think Saurabh, when he just presented here, his y-axis has return on capital. That's a balance sheet metric. That's the most critical metric for making money in the equity markets over long tenures, not short term, 5, 7, 10 years. If you want to compound, you need to buy businesses with good balance sheets, with focus on balance sheets. Likewise for countries. So India's balance sheet has been a perennial problem since I came into the markets, to the late 80s. In fact, it became such a big problem that we had a BOP crisis in 91. And the most recent occasion when we had a problem was 2013. I think the Honorable Minister made a reference to this, and it just kind of brought all my memories back about what happened in 2013, is that the Fed just said, taper, and Indian currency went down 20%. So what has changed dramatically for India in the last 10 years or 11 years is how we are as a balance sheet. It is supremely better. And a lot of work this has not happened by chance. There has been some very deliberate work that has gone. So what was one problem? I think Shamika mentioned this about energy imports. Right? So we had a very large quantity of energy imports. But the fact is that in the last 11 years, our dependence on imported oil has more than halved. And it is continuing to decline. And that is, I think, a major change that we have brought about. And it didn't happen by chance. It happened because we made better highways so our cars could go faster. GST meant that trucks were not waiting at state borders to pay taxes. We have electrified all our locomotives. So we're going to almost 90% electrification. Almost every village in India now has electricity, so they're not burning oil. In fact, in this part of the country, northern part of the country, if you remember 20 years ago, people would fire diesel gensets to generate electricity. They don't do that anymore. So we were using diesel to make electricity. So ethanol blending. So a lot of things have happened in the last 10, 11 years that has reduced the oil intensity of the economy. And that has meant a seminal shift in our terms of trade. So we are not subservient now to changes in oil prices. I mean, theoretically, even if oil doubled from here and went to $130, and by the way, it was at $130 in March 22.
Correct.
And nothing happened to India. A lot of the long-term watchers were calling me up and saying, now India is doomed, India is doomed. And I said, no, you've not seen what has happened in this country. We have changed this dynamic. The last time oil went to 130 was in 2008. And we had a crisis. Yes. Right? So we have completely changed this dynamic. And the other thing that has happened is that our dependence on global capital flows therefore has reduced. Also because FDI has gone up so much, we no longer depend on capital market flows. Correct. The FPI flows go up and down like this. Okay, they're very cyclical. And the source of capital for India in the last 30 years has only been foreign portfolio investors. So every time there was a down cycle, we would get hurt. So this is a balance sheet problem. So that's one. Second, I think second fixing that has happened is in terms of, and again I think Shamika mentioned this, is in terms of how our income pyramids have shifted. So if you go back 15 years, 20% of India's population was probably not getting dinner. This is, quite catastrophic. People were sleeping on hungry stomachs. And that number is now close to zero. There's been a major migration. Now, this is the reason why India is also the most exciting country in the world. There is no business on the planet that can afford to not do business in India. Because at the top, we have 5 million households that can buy anything, a Louis Vuitton purse, to a BMW, to a Mercedes, to an Apple phone, to a jet, anything. They are as rich as the richest on the planet. And then we have income cohorts which run into millions of people, right? Which can buy any amount of stuff. Why is this GST change so critical? Because in one night, we just transitioned a group of millions of people from here to here. And suddenly now those few millions can afford a new car, they can afford a new AC, they can afford just by reducing the price. That's the layering of the Indian economy. 1.5 billion people spread across 15, 20 layers means that we have the type of consumption potential that the world doesn't have right now. So India, our estimate is it accounts for about 20% of global growth. And one of the reasons why we are not seeing a recession in the world is because of India. And this 20% number is only going to rise. So depending on what product or service you're selling to the planet, it could be between 10 to 100% of your growth. Now, if you don't know business in this country, then you are not going to get that growth. So I think that's the second thing. So how we have altered the pyramid because of how we have addressed poverty, I think has changed the dynamics for the country. And I would say the third thing is is all the reform that is happening, which is, I think, now going to allow our manufacturing sector to grow. We have been in a perennial decline in manufacturing. India simply escaped industrial progress. We went straight from an agricultural economy to a services economy, and we never got industry going for many reasons. The IDR, which is the famous license Raj, to how our factors of production are organized, to our taxation rates, to the fact that land, labor were very difficult subjects in India, or infrastructure. I mean, I remember this joke in the 90s. We used to say that it was cheaper to import steel from Russia than bring it from Jamshedpur. Because the cost for bringing 1,500 kilometers from Jamshedpur to Mumbai was multiple times more than the cost of transport from Russia. So I think all that has changed. So that, I think, is the third reason. So, I mean, there are many more reasons to be bullish, but we'll stop here.
Sure. But then in this, I mean, India has forever been a low beta market, they say. But with these reforms, do you really think that India is kind of decoupled from the ups and downs or the volatilities of international markets?
India was never always a low beta market. In 2013, India's beta was 1.3. So that your viewers understand, it means that if the world was up 10%, India would be up 13. If the world was down 10, India would be down 13. So it would move much more than the world. Today, India's beta, my estimate, is 0.4.
Correct.
So the downside protection on India, it's it's much better. And this has happened because we have curbed inflation volatility. See, one of the first few things that the Prime Minister did when he assumed office in his first term was to address inflation. So the Commerce Minister spoke about this, that inflation had become double digit. And given his upbringing at grassroots level, he understood one thing very simply, that inflation hurts poor people the most. It doesn't hurt people in this room. It hurts the people who cannot afford to be in this room, and those are bulk of India's population. And the intrinsic reason why we have managed to extract people out of poverty is because we have brought down our inflation rate. Mm-hmm. So bringing down inflation is the surest and the best way to address this problem. And he did this by mandating the central bank to target inflation, and it has been a massive success. So the inflation, forget about the inflation rate, which has anyway gone down, the volatility of that rate is amongst the lowest in the world. If your inflation volatility is low, your interest rate volatility goes low. If your interest rate volatility goes low, your growth volatility goes low. And low growth volatility means share prices are less volatile. I think one of the global news channels just published this article yesterday, that on a trailing 75-day basis, the Nifty is the least volatile market in the world, half as volatile as the US. We did not enjoy this 10 years ago. This is the unprecedented change in our capital markets, and it's a consequence of conscious policy choices that the government has made.
But you once mentioned that the levels to which inflation has now dropped, now there's a reverse challenge to probably push it up further. Is that one? And if that's the case, you also, there was a mention that it's good for equities in that case.
Yeah, that is a challenge that has emerged in the last few months, and it has got accentuated by the GST rate cuts. So yes, CPI has gone well below the RBI's target, and the RBI is reflating. So it is now targeting a higher inflation, and that is great for nominal earnings, and it is the primary reason why I'm so bullish on the stock market for the next 12 to 18 months, because I think the RBI will succeed in reflation and earnings will be up, and will surprise everyone.
Ridham, we as common investors are forever scared that is there going to be a crash? The likes of Rich Dads, Poor Dads or Robert Kiyosaki's of the world are forever telling us, okay, there is a big crash coming now. Are we really looking at any kind of a crash? What could be the reasons behind, if at all that happens?
I have to say that equity investing is not for the weak-hearted. It takes a bit of stomach, because by their very nature, equities can be quite volatile, and if it is not in your character to bear that volatility, you're better off buying fixed income. So that's the first caveat. A crash will come, because that's the nature of markets. Markets go up a lot, and then markets crash, and then they go up a lot and they crash. My humble suggestion here is that I don't think we have gone up a lot, so I don't think a crash is imminent. But you can't rule out one in the next 5 years, for example, because again, I don't know exactly when it happens, but it will happen when everybody is buying stocks. When your taxi driver tells you, "Sir, ye share le lo, bahut paisa aega." We have not got there as yet. I think neither India nor I think the rest of the planet. I don't think equity prices are exhibiting exuberance that unnerves me. At least it doesn't unnerve me. So we have not gotten ahead of the game. We will at some point in time, and then a crash will become imminent. For people who do long-term investing, let me just bring to your attention that I've been in the markets now for 35 years, and I've seen many crashes. So let's count them. I saw a crash in 92, 60%.
Okay.
Right? That was the Harshad Mehta scam. I saw a crash in 2000. That was also about 50%. I saw a crash in 2008 that was near about 60%. There were mini crashes like 2013 when the market went down 20% in a month. There was another one in COVID when the markets went down 40%. Like, these are major declines. And yet in 35 years, the Sensex has compounded at 16%. So if you are really long-term, I don't think it is necessary for you to worry about timing these things. Time spent in the market is far more fruitful than timing. And as Saurabh pointed out, and it was something we were discussing outside as well, that it is not that every equity market has this compounding.
The Japanese market, for example, hasn't.
Well, that list, if you see, there are just 3 markets that have really compounded, and if you exclude Taiwan from that list because it's a very narrow market, diversified markets, there are only 2 on the planet that in my lifetime, in my career, have compounded. And the reason for this is because my very simple reason is because these are the only 2 places where balance sheet precedes everything else, where entrepreneurs are hyper-focused on return on capital. The word is frugal. We are a very frugal country. And we are frugal about everything. And that's how you make money in the markets. You have to be frugal. If you are spendthrift and if you're throwing money after everything, you don't make returns. And if you don't make returns, returns means equity returns. Right. So if you can't make return on your book capital, you can't make money on your equity capital. Right. You can't make money on your share price. So that is the intrinsic difference between India, the US, and the rest.
Okay. If I have to ask you for one last question on the likely headwinds that you see, if at all you see tariffs as one of the headwinds in this entire story that we are talking about, Sensex at 107,000 or 95,000 in a second best case scenario that you're talking about, what are the headwinds and are tariffs a problem?
So 95 is the base case. In a best scenario is 107, and then there is a bear case. No, you mean US tariffs, India-US tariffs?
Yes.
No, I don't think that's a very material event. It could be a small boost for the Nifty. The risk actually are that global growth falters, and we get a recession in the US, and that then prevents India's growth cycle from turning. Because the US is a very large economy and the world cannot grow unless the US is in okay shape. It doesn't have to be in very good shape, but it shouldn't be in a bad shape. So I think that's the most important risk factor. I would say, that is enough. There are other small things, but this is the major risk factor to my outlook.
Wonderful. Ridham, thank you very much for talking to us, coming all the way. Thank you very much. Looking forward to meeting you once again.
Thank you so much, Mr. Desai. Thank you so much, Pranav, for that insightful session.